Welcome to the Nichols Tax Update podcast. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in this program. I acknowledge the value and the benefit of my subscription to Tax Analyst's Tax Notes Today that provides valuable insights for my analysis of current tax developments. Let's get started. It's a short list, but some very interesting topics. An internal legal memorandum, final regulations, a lawsuit involving a bankruptcy, an issue that we don't see very often, but we probably will see more of, an information release from the IRS, and finally, the 11th Circuit Court of Appeals overrules the tax court. Let's see what that's all about. First, the deductibility of daily fantasy sports entry fees. This is the internal legal memorandum, the IRS delivering its opinion for all of us to share. Entry fees for daily fantasy sports DFS contests count as wagering transactions under Code Section 165D. That's the code section that limits deductions for losses on gambling. The argument that DFS transactions are a game of skill and therefore excluded from wagering is simply not persuasive. DFS, daily fantasy sports leagues, are more like a horse race. The bettor simply chooses players who make up a team, and it's their performance, not his, not any wisdom or smarts or on the part of the bettor, simply just to select a team that determines the outcome for the individual gambler. That's much like picking a racehorse. So what's the big deal here? Well, the taxpayer wanted to take a deduction, wanted to depreciate his computer because he used it in an income-producing activity. No. Next, final regulations on eligible terminated S corporations. A C corporation that was an S corporation but terminated its S status to take advantage of provisions in a flurry of new laws, has some special rules. Final regulations here provide guidance on the definition of an eligible terminated S corporation, an ETSC, and rules on distributions of money by an ETSC after the post-termination transition period, following special rules for an extended period to take into account the accounting adjustments caused if you have to change from cash to accrual. The ETSC has an extended period, 6 years, to take the effect of a change from cash to accrual into account. Of course, if an S corporation makes an election, or if it kills its S election, becomes a C corporation, it can't use the cash method, which was available to the S corporation. So there's an automatic requirement to change the method, but there's a special 6-year spread. And the ETSC is going to be allowed to distribute money from its AAA account to those persons who were shareholders of the S corporation long after the S election is dead. The C corporation can distribute money from the AAA account until the AAA account is exhausted. A real benefit where changes in the tax law made it impractical to remain as an S corporation, and the S corporation needed to change its status from S to C, but in the process had to give up the cash method of accounting. There are special provisions here to allow them to do that, and special provisions to allow the shareholders to get the AAA that they already paid tax on out of the C corporation. Tax consequences of loan forgiveness, not enough. for an undue hardship discharge. I read the headline and it didn't really hit me all that was involved here. First of all, we're going to see a flurry of bankruptcies of individuals who borrowed way too much money to go to college. Maybe they really did go. Now they can't get a job. Maybe they didn't understand what college was all about and they failed. Whatever reason, you got big student loan debt and not really good financial circumstances to repay the debt. That's where Jill Stevenson found herself. Jill Stevenson's 53 years old. About 15 years ago, she decided she was going to go back to school. So she's 35 years old. She goes back to school to become a lawyer. She borrows she borrows $90,000 to do that. She flunks out. She's not a successful law student. So she flunks out. Now she owes all that money. The best job she can get is as a paralegal. The potential tax consequences of forgiving her student loan debt, which is now over $100,000 alone, the court says that's not enough to justify discharge. And remember, student loan debt is not dischargeable in bankruptcy. Oh yeah. Boy, that's gonna create a mess. Well, there's a lot of litigation in this area right now. So pay close attention to this one and others that are cited. If you have a client or if someone comes to you and they have big student loan debt and they're not successful in getting a degree or they're not now successful in life and they're going to have to figure out some way to repay it or get out of it, they can, as long as their income is relatively low, they take advantage of the federal income-driven repayment plan, which allows them to make a payment based on their income. And that's what Jill did. But her $90,000 grew to $114,000, and she's been making payments for 15 years. That's not good. But the court said, nah, that's not enough. That's not enough to justify invoking this undue hardship discharge. The fact that when that debt is forgiven, you're going to owe about $35,000 or $40,000 in tax in that year, because you're going to get boosted up in tax brackets, that's going to be taxable. The judge is not willing to look that far ahead, says, no, I might be willing to take a look at the fact that you don't earn enough money to ever pay off the debt, and we can give you some kind of other relief. Watch for these. Undue hardship, federal income-driven repayment plan, not making enough payments on the student loan to knock the balance down, and that's going to create some real serious tax problems for some really nice people who just couldn't succeed in college. Instructions are released on partnership tax capital reporting. What a deal, what a dust up this has been. A partner who makes a minimal investment in a partnership to establish a capital account, where the partnership then goes out and borrows a lot of money and invests it in depreciable real property, will have a negative tax capital account fairly soon, as the depreciation on the property overcomes the income, creates losses, and the partner's capital account goes below zero. Now remember, basis can never go below zero, but your capital account can. When and if the partnership then disposes of the property, which is debt financed, there can be significant taxable income for that amount of negative tax capital. The losses claimed in excess of the partner's original investment because the partner has basis in the debt. This is one of those places where the partnership rules get us tangled up, and you can really get tangled up if you have negative tax capital. Well, the IRS wants to know where that is, because they're concerned that some people have been escaping paying the tax when their negative tax capital account is restored to zero, and they do owe the tax. So we've got all kinds of guidance on partnership negative tax capital reporting. I encourage you, if you have this issue, refer to Notice 2020-43, which was issued in June. We talked about it in this program in June, for how to calculate a partner's tax basis capital. It tells you how to do that step by step. This latest guidance allows the calculation to be made using the transactional approach, which the IRS had earlier resisted. Floating home sites. Oh, no, not really floating. Floating within a tract of land that is subject to a conservation easement. Pine Mountain Preserve LLP, a partnership, dedicated a significant amount of land to a charitable cause, qualified for a charitable contribution deduction, and in the deed they retained five building sites, 5 home sites within a several hundred acre site. And that deed also said they had the right to move those home sites around within the perimeter of the dedicated land. The tax court said, no good. It was 11 tax court judges concurred that the requirements for claiming a charitable contribution deduction mandated that you couldn't move those home sites around even within the perimeters of the land that was the subject of the conservation easement. The 11th Circuit Court of Appeals said, wait a minute, there's no more or less land given to the charity. Where somebody builds their house doesn't matter. So Pine Mountain Preserve partners can move their home building sites from the original plan to a subsequent plan without destroying their charitable contribution deduction. Simply allowing the relocation of building sites doesn't violate the contribution of the entirety of the land to the charity. Well, that's it. It was a short program this week. Until next time, please stay safe.